All right, let's jump right in. Welcome to this explainer. If you're relatively new to trading, I bet you've spent, countless hours hunting for that mythical perfect strategy. You're probably out there studying charts, memorizing candlestick patterns, scrolling through social media gurus, totally convinced that if you can just find the right system, the profits are just going to automatically roll in. But here's the harsh reality, straight from our source material today. You can have a phenomenal strategy and still lose your shirt, while somebody else with a totally average strategy consistently pulls in profits. The difference? It's not about being a genius, and it's definitely not luck. It is risk management. So today, we're going to completely unpack how the pros actually use position sizing and capital allocation to not just survive, but truly thrive.
To really get this, we need a complete paradigm shift. Just look at the stark contrast in these mindsets. When amateurs pull up a chart, they are totally obsessed with the upside. They're asking, okay, how much money can I make on this trade? But professionals, they think in the exact opposite direction. Before they ever dream about the profits, they ask one question: how much can I lose? Honestly, this single shift in thinking is what separates the long-term winners from the gamblers. The pros know that their number one job isn't making money, it's staying in the game. So here is our roadmap for today. Number 1, the truth about risk. 2, the mathematics of survival. 3, stop losses and the breaks. 4, smart capital allocation. And finally, 5, mastering trading psychology. Let's get to it.
Starting with Section 1, the truth about risk, moving from a gambling mindset to a survival mindset. Okay, the very first thing we just have to accept is that the market owes us absolutely nothing. It doesn't care if you need to pay rent, and it doesn't care how incredibly confident you feel about a setup. Every single trade carries uncertainty, period. Think about it like you're entering a massive boxing tournament. Look, if your whole strategy is to go for a wild first-round knockout in every single fight, what's going to happen? You're going to exhaust yourself, leave your guard down, and eventually, you're the one getting knocked out. The actual goal is to stay healthy, avoid taking major damage, and keep your stamina up for the whole tournament. You absolutely do not need to win every trade. You just have to survive.
And if you want to know why survival is literally everything, just look at this terrifying math. Say you lose 10% of your account. Okay, you need an 11.1% gain to recover. That's totally doable. But what happens if you let things slide and lose 50% of your account? You don't just need a 50% gain to get back to even, you need a massive 100% gain. You literally have to double your money just to get back to zero. And if you lose 90%, you're looking at needing a 900% gain. Trust me, preventing the damage in the first place is so much easier than trying to repair it.
Which leads us to Section 2, the mathematics of survival. The actual rules that keep you in the game.
The big secret here boils down to this one tiny number, 1%. I know, it's boring, it's not flashy, but it is the ultimate key to trading longevity. It means you never, ever risk more than 1% of your total account balance on any single trade, period. So if you're trading with a $1,000 account, your absolute maximum acceptable loss on a trade is exactly $10. Now, to be clear, that doesn't mean you only put $10 into the market. It means that if the trade goes completely south on you, $10 is the absolute maximum you're going to lose.
Let's actually pit two traders against each other to see how this plays out. Take trader A. They're aggressive, risking 10% per trade. They hit a losing streak of 10 trades, which, by the way, is completely normal and happens to everybody eventually, and boom, 0% of their account is left. Game over. Now look at trader B. They stick to the professional 1% rule. After taking those exact same 10 losses, they still have 90% of their account sitting right there. They are in prime shape to catch the next wave. Keeping your risks small practically guarantees you'll survive the inevitable bad streaks.
Section 3. Stop losses and the breaks. Building your emergency exit.
So how do we actually enforce that 1% rule in the chaotic live market? Well, imagine going to a dealership and buying a sports car with a massive V8 engine, but the factory forgot to install the brakes. You'd never drive it, right? It's a death trap. In trading, your stop loss is your brakes. It's simply an automatic instruction you put into your broker to close a trade at a specific price. So many beginners will just sit there, watching a losing trade plunge, crossing their fingers, hoping it magically turns around. But hope is not a risk management strategy. A stop loss completely removes your emotions and forces those losses to stay tiny.
All right, so that brings up a pretty vital practical question. How do we actually calculate our exact position size before we click buy? I mean, we know our total account size, we know we're strictly risking 1%, and we know where on the chart our stop loss is going, so how many actual shares or coins should we be buying?
Okay, here is the exact formula the pros use. Position size equals your maximum risk divided by your risk per unit. Let's actually break that down so it's not just math jargon. Say you have a $5,000 account. 1% of that is $50, so your maximum risk is $50. Now let's say you want to buy a stock at $100 and your stop loss is set at $95. That means your risk per unit is $5. Take that $50 maximum risk, divide it by the $5 risk per unit, and you get 10. You buy exactly 10 shares. If the trade hits your stop loss, you lose your $50, no more, no less. And the best part? You figure this whole thing out before you ever even open the trade.
Moving to Section 4, Smart Capital Allocation. Zooming out to the portfolio picture.
Here's the thing though, even if your math is flawless on individual trades, you can still absolutely nuke your account if you put all your eggs in one basket. To really grasp capital allocation, think like a farmer. A smart farmer doesn't just plant an entire massive field of maize. They plant maize, sure, but also cassava, yams, and some vegetables. Why? Because if a specific bug or a bad drought comes through and wipes out the maize, the other crops keep the farm alive. Trading is exactly the same. You need actual diversification. A lot of people think risking 1% on Bitcoin, 1% on Ethereum, and 1% on Solana makes them diversified. But if the overall crypto market takes a nosedive, all those trades fail together. Professionals are obsessed with managing correlated assets.
So, what does a balanced professional portfolio actually look like? Check out this breakdown. We've got 40% anchored in stable, long-term investments, then 30% allocated for swing trading, maybe just 10% carved out for those really high-risk, speculative, fun plays. And crucially, look at this, 20% sitting right there in cash reserves. This kind of structure practically eliminates concentration risk, meaning no single isolated market crash is going to wipe you out.
And I really want to zoom in on that cash reserve for a second, because this is an absolute game changer. Beginners almost always feel this burning, anxious pressure to have every single dollar doing something in the market right now. But pros, they know that cash is a position. Holding cash gives you breathing room. It gives you an incredible layer of protection. Most importantly, it's the dry powder you need to just sit back and patiently wait for those A-plus setups. Believe it or not, sometimes doing absolutely nothing is the single most profitable trade you can make.
Finally, Section 5, Mastering Trading Psychology, the psychological battlefield.
Honestly, this right here is the hardest hurdle you're going to face. You can have the slickest risk formulas on the planet, but if you can't control your own mind, you're toast. The market is literally a machine designed to trigger your deepest emotions, specifically the twin monsters, fear and greed. Fear makes you panic. It's what makes you prematurely click sell on a great winning trade just to lock in a tiny profit, or it paralyzes you from taking a totally valid setup. Greed, on the flip side, whispers in your ear after a couple of wins you're invincible. It makes you double your position size, ignore your stops, and worse, engage in revenge trading, which is basically just rage clicking to try and win back a loss, and it almost always ends in disaster. Amateurs get completely hijacked by these two emotions.
So, how do we defeat fear and greed? With cold, hard, written rules. Here is a super actionable 4-step plan you can literally start using today. Step 1. Define your absolute max risk per trade. Keep it between 1 and 2%. Step 2. Give yourself a daily loss limit, say 3%. If your account drops 3% in one day, you close your laptop and you walk away. No exceptions. Step 3. Clearly define your stop loss rules and never, ever move a stop loss further away once a trade is live. And Step 4. Track every single thing you do in a trading journal.
Speaking of journals, take a really close look at the last column on this slide, the lesson column. Amateurs only ever look at their P&L. They review their profits and losses. Professionals, they review their behavior. Are you actually logging whether you stuck to your plan? Did you let FOMO cause you to jump in way too early? Keeping a journal like this forces you to start thinking in probabilities. It pulls your focus away from the emotional roller coaster of one single trade and locks it onto your long-term execution.
And that brings us to the final takeaway for this explainer, right out of the source text. Amateurs focus on profits. Professionals focus on risk. When risk is managed properly, profits have room to take care of themselves. At the end of the day, trading isn't a crystal ball. It's not about predicting the future. It's about surviving the chaos and uncertainty long enough for your statistical edge to actually play out. So my question for you is this. Are you going to keep swinging wild, gambling for that first-round knockout? Or are you finally ready to lock down your risk and start trading like a true professional survivor?